Filing your taxes doesn't have to be overwhelming if you know what to look for. Whether you're aiming for a bigger refund or trying to avoid costly mistakes, understanding the most important tax rules, deductions, credits, and strategies can make a huge difference. From choosing the right filing status to maximizing retirement contributions and avoiding IRS penalties. Stay informed, file smarter, and make the most of your hard-earned money. Today, we will talk about tax tips every American should know before filing. So, before we start, make sure to hit the like button and subscribe to my channel. Filing taxes can be a stressful and complicated process for many Americans. With an ever-changing tax code, new deductions, updated income thresholds, and a variety of tax forms to navigate, it's easy to make mistakes or miss out on opportunities to legally reduce your tax liability. Whether you're a first-time filer or a seasoned taxpayer, understanding the fundamentals of the U.S. tax system is essential to filing accurately, maximizing your refund or minimizing what you owe. This comprehensive guide explores the most important tax tips every American should know before filing, covering everything from documentation and deductions to digital tools, retirement contributions, and filing strategies. 1. Know your filing status. Your filing status determines your standard deduction, eligibility for certain credits, and overall tax bracket. The 5 primary filing statuses are single, married filing jointly, married filing separately, head of household, and qualifying widower, with dependent child. Each has different tax thresholds and implications. For instance, head of household offers a larger standard deduction than single, and a more favorable tax bracket, but it requires you to pay more than half the cost of maintaining a home for a qualifying dependent. Selecting the correct filing status can significantly impact your refund or the amount of tax owed. 2. Understand the difference between taxable and non-taxable income. Not all income is taxed equally. While wages, salaries, self-employment income, interest, dividends, rental income, and retirement distributions are typically taxable, other sources of income may be non-taxable or partially taxed. For example, child support, life insurance payouts, and certain Social Security benefits may not be taxed depending on your income level. Gifts, scholarships used for qualified expenses, and workers' compensation benefits are generally excluded from taxable income. Understanding what constitutes taxable income helps avoid underreporting and potential audits. 3. Take advantage of the standard deduction or itemize wisely. Most taxpayers choose the standard deduction, which reduces your taxable income by a fixed amount. For the 2024 tax year, the standard deduction is $14,600 for single filers, $21,900 for head of household, $29,200 for married filing jointly. If you're eligible itemized deductions, such as mortgage interest, medical expenses, state and local taxes, charitable donations, and more, exceed the standard deduction, then itemizing might save you more. However, itemizing requires detailed record keeping and receipts. Use IRS Schedule A to calculate and compare your deductions. 4. Maximize tax credits. They reduce your tax bill dollar for dollar. Unlike deductions, which reduce taxable income, tax credits reduce your actual tax bill dollar for dollar. Some of the most valuable federal tax credits include Earned Income Tax Credit, EITC, for low to moderate income working individuals and families. Child Tax Credit, up to $2,000 per qualifying child under age 17. American Opportunity Credit, up to $2,500 for qualified college expenses. Lifetime Learning Credit, up to $2,000 for higher education expenses. Savers Credit, for contributions to retirement accounts by lower-income individuals. Residential Energy Credits, for qualified solar, wind, or energy-efficient improvements. Always verify eligibility requirements for each credit and keep documentation to support your claim. 5. Don't overlook above-the-line deductions. Above-the-line deductions are adjustments to income that lower your adjusted gross income, AGI, which can influence your eligibility for other credits and deductions. These include Traditional IRA contributions. Health savings account, HSA, contributions. Student loan interest, up to $2,500. Educator expenses, up to $300 for teachers. Self-employment tax deduction. Alimony, for divorce agreements before 2019. Because these deductions are available even if you take the standard deduction, they are especially valuable. 6. Contribute to retirement accounts before the deadline. One of the best tax saving strategies is contributing to tax-advantaged retirement accounts. Traditional IRAs, 400 and ONNICs, and certain self-employed plans like SEP IRAs or solo 400 and ONNICs allow pre-tax contributions that reduce your current taxable income. For the 2024 tax year, IRA contribution limit is $7,000, $8,000 if 50 plus, 400 and on. Contribution limit is $23,000, $30,500 if 50 plus. You have until April 15, 2025 to make IRA contributions for the 2024 tax year. Contributions made before this deadline can reduce your tax bill if you're eligible for a deduction. 7. Keep comprehensive and organized records. Good record keeping is the foundation of accurate tax filing. At a minimum, keep W-2s and 1099s income reporting, Form 1098 mortgage interest, bank statements and investment records, receipts for deductible expenses, charitable donation acknowledgments, HSA and retirement contribution documentation. You should retain these records for at least 3 years from the date you filed your return, or longer if you file late or underreport income. Use folders, cloud storage, or financial software to keep everything secure and accessible. 8. Report all sources of income, even gig work and side hustles. With the rise of freelancing, gig work, and online income streams, many Americans earn additional income outside of traditional jobs. All income over $600, and sometimes less, is reportable, even if you don't receive a 1099. Failing to report this income can lead to audits and penalties. If you earn self-employment income, you may be responsible for self-employment. Taxes, 15.3% for Social Security and Medicare, and should consider making quarterly estimated tax payments. 9. Be strategic with capital gains and losses. If you sold investments like stocks, real estate, or crypto during the year, you may owe capital gains tax. Short-term gains, assets held less than a year, are taxed as ordinary income, while long-term gains have favorable rates, 0%, 15%, or 20% depending on income. However, if you sold assets at a loss, you can harvest those losses to offset gains. You can deduct up to $3,000 of capital losses against ordinary income per year, with excess losses carried forward. 10. File electronically and use direct deposit. The IRS strongly encourages taxpayers to file electronically and opt for direct deposit to receive refunds quickly and securely. E-filing reduces errors and speeds up processing, especially if you're using IRS Free File, F-Tax software like TurboTax, H&R Block, or TaxAct, or hiring a professional. Paper returns are slower to process and more prone to mistakes. Direct deposit ensures faster refund delivery, typically within 21 days for e-filed returns. 11. Avoid common filing mistakes. Simple errors can delay refunds or trigger audits. Common mistakes include misspelled names or incorrect Social Security numbers, math errors, filing with outdated tax forms, not signing your return, incorrect bank routing/account numbers, overclaiming deductions or credits without documentation. Double-check every entry and consider using reputable tax software or hiring a tax professional if your return is complex. 12. Know the deadlines and file on time. The standard tax filing deadline is usually April 15, unless it falls on a weekend or holiday. If you cannot file by the deadline, you must submit Form 4868 to request a 6-month extension, moving your deadline to October. However, this is only an extension to file, not to pay. Any taxes owed are still due by April 15, and late payments incur interest and penalties. Even if you can't afford to pay your full tax bill, file on time to reduce penalties and work with the IRS on a payment plan. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.